Please help me welcome Rip Robinson.
Thank you. I love telling stories about claims. I love dealing with claims. I'm just put together a little differently, I guess, that way. But if you have an issue, or if you have something like, oh, that happened to me, feel free to raise your hand and we'll talk at any time. We're going to cover some real-life examples of claims, and then we're going to talk, if I have time left, how to respond to claims. And who knows, I may not have the time left. Can we go back one slide? I guess we can't. We'll stay right here. All right. Anybody have a trouble when you go to a cocktail party trying to explain to people what you do? I do. And this explains it perfectly. Because if we can go back one slide. We're going to have you sit there or something, I think, Les. Oh, that's forward. That's off. One more down. All right. Oh, we're working. As long as it goes forward, I'm never going to go back. Okay, this explains what I do perfectly. Again. If you can't read them, the upper left-hand corner says, this is what my friends do, that I party and drink all day long. The middle one says, this is what my mom thinks I do. Hi, Mom. This is actually what I do. This is what society thinks I do. They sell some kind of insurance to people, probably automobile, property casualty, housing insurance. Customers think all I do is sit and collect money. What I really think I do is I herd cats all day long. But what I really do is I sit and look at my computer and hold my head in my hands. And I will ask you each, what is the one word that I hear every day walking down the hall in my office? It's not a 4-letter word. It's a 5-letter word. It's really? Really? That's what we did? But yes, that's what we do. And thankfully, we have a great industry. I'm very proud to work for First American, but I'm even more proud to work in the title industry. You are truly, truly professionals at what you do. We are a risk aversion type of insurance. People don't get that. But it's because of the work that you folks do that people start saying, well, you don't pay out claims in title insurance. Or because of these things, title insurance doesn't have a value. But title insurance does have value. And I'm here to say that First American pays $336 million a year in claims. And we're telling homeowners that it's optional. But we'll talk about the CFPB in a minute. I want to go over some statistics for Idaho. And remember as I'm going through these, exactly what Mark Twain said. There's a lie, then there's a damn lie, and then there's statistics. As Vin Scully says, statistics are used much like a drunk uses a lamppost, for support but never enlightenment. So with that in mind, what's causing our losses in Idaho? 57% of the losses, these are First American figures. I don't have industry-wide figures, but 57% of the losses for First American are from lenders' policies, 43% from owners' policies. Look at what causes, however, those particular losses. 69% is search and exam. Well, isn't that the same thing? No. Anybody who knows title knows that search is one thing and exam is another. Search, it may be missed in the search. Exam, it may be reviewed in the exam, even though it's found in the search, but determined either to be not applicable to the property or have been ignored or have missed in the exam despite the fact it was found in the search. So there are ways that those particular losses can be avoided, and that's by improving your processes. But what are our other processes? Escrow and closing processes. 20% of the losses are caused on that end of the business. That doesn't add up to 100%, and that's pretty much all we do. Where's the rest of this stuff come from? Well, the rest of this stuff comes from no apparent process error. How do you have a loss in a claim if everybody did something right? Does everybody know that our policy covers fraud in the back chain? We are the only insurance policy in the country the only insurance group that actually covers fraud. We protect owners, sellers, buyers from prior fraud in their title chain. And that's where 2% of the losses, at least in Idaho, come from. Nationally, that figure is about 8 to 9%. Underwriting. Where are underwriters? 5%? No. This is a category where you have called your underwriter and said, look, this is the transaction I've got going on. This is what's happening here. These people want to know if I can insure it. Most of the time, we're right. Sometimes we're wrong. But as far as you're concerned, we're right all the time because it's never your fault if we tell you to do it anyhow. So I will encourage you as we go through this discussion to remember, as we talk about these things, you can always call your underwriter and get a person to call balls and strikes, to say yes or no. And that is your safe haven. Take advantage of your state underwriters, and you won't be looking at me asking you why you closed this particular transaction. Yes, sir. I don't know if you want questions during the process, but why not? Where does material and labor lien claims fall in that percentage of claims? What kind of mechanics lien claims? Mechanics lien claims would fall, excuse me? No, they would fall in a separate category. They are, if you add all those up, they still aren't at 100%. They would fall in another category. And I would mention to you that our underwriting with regard to mechanics lien coverage has become much more robust, if you will. That's a nice way of putting it, isn't it? Robust since the downturn of the market. Before the market downturned, we were giving out mechanics lien coverage like Pez candy. Now there has to be some thought put into that coverage, and you folks are the ones on the front line letting us know what the deal is about, what kind of transactions we can actually do. Before I go into my real spiel here, I wanted to talk to you just a second about TRID and CFPB. For those who can't read the bottom here, it says, government, if you think the problems we create are bad, just wait until you see our solutions. And that's really what's happened with TRID and CFPB. The government has allowed all of the big banks and everybody else to do what they're doing, and then they said they can't do them, and then they have to regulate them, and then they can't regulate them, and they're too big to fail. But for all of that, for all the political rigmarole that we've gone through, for all the problems, whether you're Democrat or whether you're Republican, CFPB and TRID are not going away. Don't live in the fantasy that a government agency that is now the largest government agency in the country is going to disappear at the next election. There's too much momentum. There's been too much done. It's here to stay, folks. So I'm reminded of the phrase, you can either stand in front of the train or get on the train. Please get on this train, because if you stand in front of it, it's going to mow you over. All right, enough of my lecturing. Let's talk about cybercrime. Well, why the heck is the claims guy talking to me about cybercrime? I want to hear about some fraud. Well, this is the hottest issue in fraud in the country, cybercrime. You guys are high-value targets for people looking to steal money. Why me? You have literally millions of dollars running through your escrow accounts. If I were someone looking to steal money, that's the kind of account I'd like to steal money out of. So what is cybercrime? It's the theft of personal information or passwords leading to economic loss. Your company could be the next victim. Personal deposits are protected by the FDIC, but business deposits are not. If something gets stolen out of your business account, there is no governmental protection. Cyber thieves attack businesses that handle large sums of money, i.e. you. We heard talk about passwords earlier today. Passwords are dirty words according to most people, because the tougher you make them, the more people write them down, or the more people use the same password all the time. So some of what we heard in the social phishing expeditions in the earlier lecture. A 2012 study said that 1/3 of the people have more than 10 unique passwords, and 38% of the people would rather scrub toilets than come up with another password. Me too. Passwords, the top 10 passwords in 2014. Wow. How tricky. These are the actual top 10 passwords used by people to protect their information in 2014. Does anyone know what QWERTY is? That's exactly right. They're the top 5 keys on the left-hand side of your keyboard. Sound very safe? Let's see what happens if you don't protect your business accounts and your agency from cyber theft. Cyber theft is increasing. It rose 48% in 2014 to 42.8 million attacks. That was more than 117,000 attacks a day, and that's in 2014. I just found this article on the 22nd. PricewaterhouseCoopers says that 54% of U.S. respondents and U.S. companies say that they have had some type of cyber attack. Folks, don't think it can't happen to you. If they can hack the IRS, I think they can probably hack into a computer system in Boise or Moscow, Idaho. Some real-life examples of what happens with title agencies, and remember at the end of this story that this was the good outcome. Village Escrow versus Professional Bank. Village Escrow caught a virus because what happened is that the owner of the company got an email from what looked like UPS saying your package was not delivered. Please click here. She clicked on it, couldn't get it to open, so she sent it to her assistant, who clicked on it, couldn't open it, and all of a sudden every computer in the entire company was now infected. These people then hovered and waited until there was money they saw coming in because they were watching their emails. They literally had complete access to their email account. And they made 26 consecutive wire transfers over a period of 2 days, totaling $465,000. This lady went to great lengths to try and get the money back. She worked very hard. She tracked down money mules, people that this money was going to from the account that it got wired to in the United States to people in Russia using Facebook and other social media, and got $70,000 back of it herself. But the rest was poof, gone. She sued her bank, Professional Bank, because she had a system with the bank that would let her know every time the bank made a wire transfer, she would receive an email to her email account. Well, guess what? The hackers found out about this or knew about it and disabled that. So she didn't get the email, so she didn't know about it until her account was overdrawn. She sued her bank because her bank said that they had state-of-the-art prevention for this type of fraud, and she had signed up for every protection that they had, and she actually won. Well, she won, but she won 3 years later after having to take out a $395,000 mortgage against her own home in order to fund the hole in her escrow account. And that's the good outcome, folks. The bad outcome, there were 2 that were reported, and understand that not a lot of these get reported. Most of these companies simply just go away. In 2013, Efficient Services Escrow in California was hacked for $1.5 million. They were able to recover just over $432,000, but were still left with a $1.1 million hole in their escrow account. State of California closed them down within 5 days. Choice Escrow versus Bank South is the only major litigated escrow shortage or escrow hacking account case that's gone up on appeal. In this one, Choice went to their bank and said, we want escrow protection. The bank said, well, you have to do this, you have to do this, you have to do this. And they said yes and yes and yes. And also, by the way, you have to have 2 people approval, and there's another level of protection we want you to put in. And the owner simply said, you know, that's just going to be too hard. No. Yes to 3, no to 2. And guess what? They got hacked. They got hacked for one very large withdrawal, $440,000, that immediately went overseas. They sued their bank because they said if the bank had acted properly, they would have been able to prevent this. Indeed, they said that if the bank had had appropriate protections, they would not have lost their money. The bank countered with, well, We offered you 5 protections, you only accepted 3, and here's in writing where you rejected the other 2. Choice lost in the trial court, lost in the Court of Appeals, and the writ of certiorari, which we heard about earlier, to the United States Supreme Court was denied. They're now out of business. Well, how do I protect myself and my company? ILTA Pillar 3, best standards with regard to protection. General protections are you can use only one computer for your wire transfer accounts. Don't do anything else on that computer. Well, shoot, that's what, $450? That's a fair amount of return for protection. If you can, get a Mac. Macs are less susceptible to this type of attack than are PCs. Work with your bank and take advantage of all of the safeguards that they offer. Call your banker. Say, hey, we've done business for 500 years or 5 minutes. I don't care which, but tell me what I can do to protect myself and what we can institute between you and me to make my account safer. And in those situations, it's the best case scenario. You still may end up with a hole in your escrow account, but if it's because of anything that the bank did or failed to do, you can possibly recover your money. Put limits on the amount of transfers that people can actually transfer. Prohibit international transfers of all kinds. Tell your bank if anything is going internationally, do not send it. Simply do not send it. It's much easier to go to your bank and work that out if you have an international transfer than allowing money to be taken out of your account. Something that I've seen and something that I think people are doing is go old school. What do you mean? Communicate with your bank or with these people by fax. Wow, does that sound like 1980s technology or what? But it's not hackable. Communicate by fax. Be very, very careful with your emails. And because this is what I call direct hacking. But then the next and most recent cyber fraud has been that people are hovering on accounts of people that you deal with. They haven't hacked you, but they've hacked the mortgage broker, or they've hacked the real estate agent, or they've hacked the attorney's account, and they're just sitting there monitoring the emails to see when somebody's going to close a transaction and when a wiring instruction comes across. And then they hijack that account, and they send you false wiring instructions. This is a case that I dealt with specifically in Illinois. Mr. and Mrs. Smith were actually selling a piece of property in southern Illinois, moving to northern Illinois, and moving actually funds from one of our direct operations to an agent operation in northern Illinois. Well, unbeknownst to them, their realtor's account had been hacked and their attorney's account had been hacked by the same group of people. And what happened is that the attorney got the information from the Smiths. Here's our account. Please wire it to, and they actually used our agent's trust account because that's where the funds were going for the purchase. That email got intercepted, and an email got sent instead saying, send it to Chase Bank in San Francisco with the beneficiary of Horace Frederick White II. Well, our escrow officer caught that. And the escrow officer said, are you sure this is where you want to go? At the closing table, Ms. Realtor, is this right? Yes. Mr. Attorney, is this right? Yes. Mr. and Mrs. Smith, is this right? Yes. Would you just close our transaction? So the escrow officer had Mr. and Mrs. Smith actually sign the wiring instructions. Sure enough, after a day and a half, the Smiths wanted to close on their property in northern Illinois. The monies weren't in our escrow account. They obviously got transferred somewhere else. And the Smiths have now sued the real estate agent, the law firm, and First American for not having prevented them from sending the money where they specifically said in their own closing that the funds had to go there. I would urge you that if you are wiring transferred funds out of a closing, particularly large payoffs, I would have the borrowers or the people actually transferring the money, whether it be a buy or sale, sign the wire instructions. You'll save yourself a lot of anguish, and it's very likely that First American will get out on a summary judgment because this escrow officer was fast thinking in what they were doing. All right, let's talk about some real claims. You want to talk about fraud? This is a doozy. Everyone's heard of the Pirates of the Caribbean. You know, it's easy to find gold buried treasure somewhere on the island if you have the map and if you have the X marked spot. Well, these people decided that they could do the same with real estate. Not only real estate, but very, very, very expensive real estate in Southern California. The extent to what these people went on their fraud is amazing. And I want you to think of the number of times that they could have been stopped at any time during this particular transaction. What did they do? They found a piece of property in a very well-established neighborhood in Southern California. It had been owned since the late 1950s by the same couple. Husband had passed away. Wife was obviously widowed. She didn't live in the property. She lived actually in a very high-end condo in town. But she still maintained the property as the family residence. $5 million worth of property in a gated community. They determined that there was no mortgage. It's been owned for more than 30 years. These people were rich. They'd already paid off their mortgage years and years ago. That's number two. They determined that the lady did not live there. She lived in the condo downtown. So it was generally vacant. Well guarded, but generally vacant. So what did they do? They said, we're going to steal this piece of property, and here's why we're going to do it. They looked for a real estate broker in the general area who had, several years on him and really wasn't selling that very many properties anymore. And they actually found a listing for a broker who kept his license but was living in Arizona. They simply wrote to the Real Estate Commission and changed his address, his email, and his telephone number to their address, email, and telephone number. And they assumed his identity. They then used his identity to create a listing in the multiple listing for the area. They listed it as a $5 million house on sale for $3.5 million. And were flooded with calls. A very, 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 very desirable neighborhood. And their response was, you can't go in and see it. The lady is a recluse. She doesn't like people around. She's only selling it because of health reasons, so she doesn't want people around. But we have extensive pictures inside and out. And they did. How did they get extensive pictures inside and out of the house? Excuse me? No. They went to the house and broke in. And the alarm went off because it's a well-protected neighborhood. And the guy said, I'm the real estate broker and I'm here with the lady. She can't remember the code to turn off her alarm. And he convinced the alarm company that he was the broker and that this lady was staying right next to him and she was very flustered and very upset. They turned off the alarm and called the cops and told them not to come. So they had full run of the place. They had all the pictures you wanted. Now you got a $5 million property being sold for $3.5 million, and every time somebody called, the answer was, yes, that's the price. She wants to sell it, but it's got to be cash. And they had offers. They had multiple offers. It was listed for $3.5 million, but sold for $3.8 million. The requirement of the real estate sales contract was you could buy the property, but you could not get access, you could not obtain possession for 7 days post-closing. That's how it comes into the First American office. $3.8 million cash sale, no deed of trust to pay off, no liens against the property. Boy, that sounds like an easy transaction, doesn't it? Oh, same owner since the 1950s. Transaction closed, but you're thinking, well, okay, the guy's going to close the transaction, but he's just so far imitated the real estate broker. So what does he do? How does he get title so that he can transfer it? Well, he's already told everybody in the world that this lady is a recluse. So he says, I will deal with her. You guys don't want to deal with her, believe me. and I'll deal with her, and I'll get a deed, and I'll bring it to closing. He was so careful in what he was doing that he even stole a notary seal 3 months earlier before the transaction, so if somebody checked with the notary would be valid. Transaction closed, deed goes of record, $3.8 million comes in, 3.7 something goes out. Well, that would have been the end of the story, and First American would have had a $3.8 million loss. Except, buyers being what buyers are, the buyer decided that he was going to go to the house and just drive by. And sure enough, there was a little old lady getting out of a car in the driveway. And he couldn't help but stop and say, "Hi, let me introduce myself. I just brought your property. I'm so glad I was able to get it." And apparently there's a lot of ways to make an old lady say a curse word, and that's one of them. I hear the other one is to yell bingo. But she let him have it like you would not believe. "I didn't sell my property. You were out of your mind. Get off my property," because apparently she was a little crusty anyhow. Well, all of a sudden, buyer calls his agent and says, "Hey, this lady says I haven't bought her property. She didn't sell it." Buyer tries to call seller's agent, doesn't get an answer. Doesn't get an answer. Doesn't get an answer. Finally, they do some investigation and find out that the person had recently changed their address, so they called the number that was previously listed. The guy that called, obviously, is the person down in Arizona. He says, "I haven't sold a piece of real estate in 5 years." So guess who their next call was? First American. Within 5 days, First American had paid the seller the buyer $3.8 million to resolve the claim. We got lucky. Why did we get lucky? Because these people didn't try and wire transfer the money out. They intended rather to buy bullion and ship bullion out instead to avoid detection of wire transfers. So we were able to track down where the first wire transfer went, then from there where the money went, and then to find that it had actually been wired to a bullion dealer, and we were able to recover $3.2 million. How many times can I say, a $500,000 loss and I feel lucky? Let's talk about what happens sometimes with HELOCs. And we're in an improving economy, folks. HELOCs are coming back, and they're coming back with a vengeance. Everybody who couldn't do a refinance anymore because all the refinances have been done are now looking to sell HELOCs because they're easy. Banks are pushing HELOCs. People have equity again. Everybody who's delayed all of the stuff that they want to do for their property for the last 7 years are now taking out home equity loans and redoing their homes. Great. I'm all for the economy. But things like this happen. Here is a letter. This was an actual attachment sent with a check, payoff check to the bank. And you can read it. Anybody here can tell me what's wrong with it? Realizing this is the actual document sent to the bank. It's not signed by anybody. Unless the bank received a signed one of these, it had no obligation to close this account. And it did not. And sure enough, within 2 years of this closing occurring, these people had again run back up their HELOC. Now this one only cost me $28,000. And I say me, I take some of this very personally. Only cost First American $28,000. But we had to pay off this prior HELOC because it simply wasn't signed at closing. It just got missed. Most I've ever paid on a HELOC, Atlanta, Georgia, and the claim, as it says here, was Slaughter. That was actually the name of the people who had actually bought this property. What happens in Georgia is that the foreclosure process is different there, and there is no need to give notice to any junior creditors of a foreclosure if you're a senior creditor. The Georgia Supreme Court has determined that that is just between the borrower and the lender, and there's no other notice required. What happened here is there was an Atlanta Hawk who lived in a very beautiful neighborhood in Atlanta who got traded to another team. And apparently the woman he was living with didn't want to leave Atlanta. So it ended up in a fairly messy little, not necessarily domestic dispute, but domestic change. And so he left without even worrying about his mortgage, and she left without a penny. But she had this little card that he had given her that she could get money with. And this little card was on HELOC. And most HELOCs, okay, 25, 50,000, 125, ooh, how about $275,000? This property got sold. Eventually, the HELOC got paid down to zero, but did not get closed at closing. And this lady continued to use the little card. So, because of the change in ownership, the HELOC now became first because the actual mortgage got paid off. Our insured mortgage stayed now in second position for $1.6 million. And by the time we found out about the claim, the property had already been sold to a third party. So HELOCs, that can't cost you that much money? Over $1 million to resolve that issue. These are all the post-closing issues that I see every day. I deal with them and I put my head in my hands and say, really? I don't know who you folks have doing post-closing, but one of the issues that I'm dealing with most now is documents either not recorded or documents recorded without an Exhibit A. Who's ever done a title search and come across a document not containing Exhibit A? If you've done one, you've probably seen one. Let me tell you what happened in Colorado. Completely under the radar, the Colorado Supreme Court entered an order or entered a decision that scared the heck out of me. What happened here is no title insurance company was involved, no title agency was involved. What you had was a person who filed for bankruptcy, and therefore the bankruptcy trustee was involved, and an estate attorney. Then they were both filing over whether or not the deed of trust that was filed against the bankrupt's estate was valid. The bankruptcy trustee was saying, no, it isn't valid because it doesn't have an Exhibit A. The estate's attorney, the people who had lent the money, said, oh, yes, it was, because it has the address on it. It identifies the people. It has the assessor's PIN number on it. It's got all the identifying marks. All it does, it doesn't have an Exhibit A, but that isn't effective. Well, the bankruptcy court said, I can't decide this. This seems like Colorado law. I'm going to kick it up to the U.S. District Court. U.S. District Court says, I can't decide this. This sounds like Colorado law. And they certified a question to the Colorado Supreme Court. And the thing about certifying a question to the Colorado Supreme Court is it doesn't get reported. There isn't a Court of Appeals decision that everybody reads and says, oh, that could be trouble. Let's see what the Supremes do. It doesn't get reported. So what we now is have a question from a bankruptcy judge with two people who don't know anything about title fighting over title. And what does our Colorado Supreme Court decide to do? It renders a decision that says that every document that is recorded without an Exhibit A is void. Ponder that for just a second. Every one of them is void. That means if in 1980, 10 transactions back, a deed of trust that was foreclosed was filed without an Exhibit A, that everything that happened after that date is void. After we unclenched the Land Title Association of Colorado, we call ourselves ILTA, tried to determine what kind of problem the Supreme Court might have just caused for us. We did a search of the Colorado records from Fort Collins to Pueblo. If you know anything about Colorado, that's really the entire Front Range area. Holds about 80% of the population in Colorado. And in those counties, there were less than 0.1% of the documents filed without an Exhibit A. Raw title industry. There's still over 120,000 documents. I'm still alive, so we must have fixed it somehow. We worked quickly with the attorneys that were involved in the litigation because neither one of them wanted that particular result either. They simply wanted the judge to tell them whether it was secured or not that it was void. So the attorneys came to us, we submit a request to the Supreme Court for them to reconsider their decision and to file an amicus curiae brief on the issue. They allowed us to do that. They withdrew their decision in the meantime. And in our following legislature, we had a definition then of what happened if an Exhibit A was not filed with a document. And the Supreme Court has now determined that it's no longer necessary for them to reconsider their decision, and it's been withdrawn, and they won't rule or tell us they were wrong, but they won't enforce their ruling that it was void. But all of this can be avoided. All of it can be avoided if the person you have checking the documents before they file just simply looks to see if there's an Exhibit A. I don't care whether that's a high school kid, an intern, or your grandma. That's the person that you need to make sure that there is an Exhibit A. This is something I discovered in Arkansas, and I'm doing okay on time. Cool. Please don't do this. It's a little hard to see, but you'll see that this is a deed signed by Warren G. Hall and Martha A. Hall, deceased. If you ever come across this in your chain of title, you might have a question or two. But what's really interesting is that the notary notarized it as Martha A. Hall, deceased. Apparently, that's how you pass title in Arkansas. Wrong mortgage getting paid off in a closing, and this will probably be about where I end. I could stand up here and tell stories all day long, and I really enjoy doing this, folks, and I appreciate you asking me here to do this. In this case, you've got the Mashads, Dr. Mashad and Mrs. Mashad, their attorney, Ms. Smith, the Bertones, and their agent, Ms. Jones. What happens here is that this is at the height of the bubble, just before it burst. The Mashads are older folks looking to downsize. He's a doctor. They've got some spare cash, and they want to really downsize, go from a 5-bedroom house down to something that's smaller, and they're going to sell their house for $500,000. Well, the Bertones have a starter house that they've been in, and they've taken advantage of the bubble, and now they really want to buy a bigger house. So they're going to buy the house from the Mashads. Well, the Mashads have planned ahead. This is the time, remember, when real estate was going great guns, so they knew that they had to have a new house before they sold their old house. And they went ahead and bought a new house and financed it, almost 100%. Something like, I think it was a $400,000 house, and they financed $250,000 and had a $150,000 HELOC that they'd drawn a little bit on to do repairs and everything else. So the Mashads now have got their new house. They're ready to sell their old house. The Bertones are ready to buy it. And sure enough, they enter into a contract, and they set a closing date. And the Mashads said, we can't make the closing date. We've had a long-term plan to go to Africa on a safari. And they had. There was no fraud involved in their part on that. So they got their attorney, Smith, to do everything for them. And Smith got a power of attorney, and she, I should say, requested the documents from their lender for the payoff. And closing went fine. $500,000 house, payment of a commission, and payment of no first mortgage, but a HELOC. Okay. Well, there was actually a first mortgage of nearly $400,000 on the Mashad's house. But it was a loan by the same lender that they'd used for the purchase of their new house. Different loan numbers, different transactions. But Attorney Smith got it wrong and got a payoff for the wrong loan. So what happened is, when this property sold, the Mashads walked away with about $393,000. Their prior first mortgage didn't get paid, nearly $400,000, but their HELOC on their new house did. Woohoo! So, sure enough, you'd think that, well, that's a problem, but that can be fixed. Mashad's a doctor. He's got to have some money. They have equity in the new house because, first of all, their HELOC got paid off. So there's got to be some money there. We actually should be able to fix this. And you're right. We should have been able to, but we didn't receive the claim. I realize this happened in 2006. We didn't receive a claim until 2011. And why? Well, the Mashads came back from their vacation, realized their windfall, and decided to use the money anyhow, and continued to pay upon their prior first deed of trust on their first home for a number of years. Then they ran out of money and used the entire HELOC that had been paid down but not closed out of the second house. So now we are here in 2011, and the Bertones are saying somebody's foreclosing on our dream home. By the way, their dream home had gone from $500,000 in worth to $325,000 in worth in that period of time. But there's a prior lender foreclosing on it. We've made our payments. Why is the prior lender foreclosing on it? And the more we investigated, the stranger it became. Because everyone eventually got sued. We paid off the prior loan, took a subrogation of that loan, and went after the Mashads. Sued the Mashads in the name of the lender. And during that particular foray, the Mashads decided that the best defense is a good offense. So what they did is they sued their attorney Smith and the agent Jones for not catching it in the closing. Shame on them. Well, later we find out that really attorney Smith probably should have been sued, because guess what? Attorney Smith realized within 2 weeks of this transaction that she had made an error. But she was too embarrassed to talk to anybody about it except the Mashads. The Mashads come back from their safari in Africa, and she says she doesn't say, she writes them a letter saying, here's what we talked about. You're going to take whatever money you have left and pay down that mortgage. Then you're going to make $5,000 a month payments on that mortgage until it's paid off, and shame on you. Well, the Mashads made payments for about 3 months, and then they stopped making payments. And was Attorney Smith following up? Was Attorney Smith doing anything? No, she wasn't. So the problem lingered for more than 5 years. The overall result of this is that Agent Jones paid a small amount of money simply to keep from going to trial. The Attorney Smith paid the majority of the loss, about $200,000, and First American paid the rest. But again, know your documents. Know what's coming into your closing. Never do what we heard in the first example, which is let somebody bring a deed to closing. So many people say, well, I don't want to upset my good customer. You don't have to upset your good customer. What you have to do is make it a service to them. Oh, you can't be available for closing? Oh, Ms. Smith can't be available for closing? I have a mobile notary who'd be more than glad to take the documents to them. Heck, call me. If they've gotten, if they got something outside of Idaho and you need an office for somebody to go to, I'll find a title office somewhere, anywhere in the country that will be more than glad to take your documents, have them signed, and return them to you for no cost. Make it a service. You will find that if you make this a service for your clients, those that are trying to commit fraud will go away. Those that want to do a legitimate transaction will work with you to get it done. I have about 20 more stories, but I have no more time. I truly appreciate you folks asking me here to talk today, and I've enjoyed talking to you. Have a good afternoon.